Oil over $100, gold over 5,000, Iran's new supreme leader threatens to close the Strait of Hormuz. And yet, India is still sending ships through. This isn't a normal week, this is a paradigm shift. And if you have hard assets in your portfolio, you need to understand now what this means for your position. Welcome back to the weekly review. The dominant topic, and probably for the coming months, is the Iran conflict. Since the 28th of February, when the US and Israel started the war against Iran and Khamenei was killed, the Strait of Hormuz has been de facto blocked. Iran's new supreme leader, his son Mujtaba Khamenei, on March 12th, publicly stated that the blockade will remain. But, and this is the new development this week, the blockade is crumbling. On Friday, 2 Indian gas tankers and a Saudi oil tanker carrying 1 million barrels passed through the strait. Iran is allowing selective passage. India yes, Turkey yes, the USA and its allies no. And that's no coincidence. This is geopolitics in real time. What happened to the price? Brent closed at $103 on Friday, the second day in a row above 100. At its peak, Brent even reached $120. The EU has announced the largest emergency release of all time, 400 billion euros, 400 million barrels from the strategic reserves, and yet the price remains in the triple digits. Restart Energy expects that with a 2-month conflict, we will see Brent at $110 in April, with 4 months $135 by June. The market does not believe in a quick solution. Trump says that many countries will send warships to Hormuz, but even the Pentagon says that the US Navy is not yet ready for an escort mission or port mission. For hard-nosed investors, this is a game changer. Anyone holding oil and energy stocks is currently seeing cash flows explode, but be careful. If you hold mining stocks, your production costs will rise as well. With oil at $100, iron ore is expected to rise by 20% and copper by 16%. And then there's gold. Gold almost briefly broke through the $5,000 mark this week, to the downside. But it recovered over a $100 bounce on the same day. This shows that volatility is brutal, but the trend remains intact. Gold has risen 85% in the past year. Silver, and that's the real madness, 260%. Copper has reached all-time highs above $12,850 per ton, according to the Bloomberg Commodity Dollar in Q4 2026. Bank of America says 6,000 by spring, and Wells Fargo forecast between 6,100 and 6,300. Wells Fargo is going for 6,100 to 6,300. And this isn't a spike, it's a structural supercycle. The drivers are central banks continue to buy gold for currency diversification, silver benefits from EV batteries, solar and hydrogen, and copper is all about hyperscale. An AI data center consumes 50,000 tons of copper. That's 5 times more than conventional data centers. Anyone who has miners like BHP, Vale, or Fortescue in their portfolio is sitting on a structural tailwind, but costs are rising along with the oil price. And that's exactly the balancing act. Now, onto a topic that is still making waves. On the 20th of February, the Supreme Court declared Trump's IEEPA tariffs unconstitutional, 6-3. Chief Justice Roberts ruled that the IEEPA law does not give the president the power to impose tariffs. The Liberation Day tariffs, the trafficking tariffs on China, Canada, Mexico, all illegal. 3 weeks later, we are seeing the consequences. The US Treasury is facing an obligation to repay $175 billion to over 330,000 importers. Walmart, Amazon, Target, the big retailers are benefiting massively. At the same time, it's a fiscal disaster for the US. And that's the update for this week. Trump is now using Section 122, the Trade Act of 1974, as a workaround. That allows for a maximum of 15% global tariffs. In addition, Section 232, that is the steel, aluminum, and auto tariffs, remains completely untouched by the ruling. The market reacted positively after the ruling, but in the meantime, sentiment has become cautious again. Wells Fargo estimates that the removal of tariffs would increase S&P 500 earnings by 2.4% by 2026. But the uncertainty remains. Trump is looking for and finding workarounds. For European exporters, this is good in the short term. For our shipping sector, the impact is mixed. Fewer tariffs mean more trade volume, but the auto tariffs remain, and that will most likely have an impact. Autoline is directly affected. Now let's move on to the shipping sector. At the beginning of March, the World LNG Shipping Index broke through the 200-point mark for the first time in history. 208.8 points, up 7.34% in a single week, while the S&P 500 fell, and the trend continues. LNG tankers are directly benefiting from the Iran conflict and the Strait of Hormuz. COSCO Shipping Energy up 21%, Tasco's Energy Navigation up 13%. At the same time, the car carrier market is under pressure. Trump has announced a 25% tariff on all car imports. Höegh Autoliners, our largest position, handles 12% of inbound volume and 13% of outbound volume at US ports. The share price has dropped from 130 to 120 Norwegian krona. In addition, there are annual additional costs of $70 million due to rising port fees, but Höegh is fully booked until the end of 2026. They have 15 long-term contracts worth over $100 million. Asian demand is strong, and China is driving growth in car transport, though in the short term, there are headwinds from tariffs and port fees. In the medium term, Höegh remains a cash flow monster with long-term visibility. The question is the market pricing in the quality of the contracts correctly, or is it overreacting to the tariff headlines? Mining had a turbulent week. The sell-off on Tuesday was severe, triggered by the escalation in Iran. BHP lost 5.6%, Vale 6%, but, and this is remarkable, not a single top miner is down year over year. Many have doubled or even tripled in value. Coal is at $133 per ton. Newcastle benchmark. The IEA warns of declining US demand, but expects coal exports to rise in 2026. And now the honesty. Tungala, our coal position, reported a headline loss of 5.5 to 7.5 Rand per share for 2025. The reason? A non-cash write-down of 8.8 billion Rand. Due to low seaborne coal prices and the strong Rand, operationally Tungala is still delivering, but the balance sheet shows that 2025 was not a good year for coal. BHP chairman Ross McEwen says the Iran conflict has little direct impact. Almost everything goes to Asia. The rise in oil prices is a double-edged sword for mine. Higher energy costs eat into margins, but at the same time, geopolitical risks are driving up commodity prices. Coal remains the most hated sector, and that's exactly why it generates cash flows that no ESG fund will touch. Let's take another quick look here, shall we? I'll just quickly pull up my MB Finance Mate dashboard. And here we can finally see what's bearish and what's bullish, so to speak. Energy remains bullish, bearish is like this. Technology, so tech stocks, finance, mixed in industry and commodities, and in consumer staples. Otherwise, as I just mentioned, we can see it here as well. In the shipping cycle, we've basically seen everything increase here. The entire index is currently elevated. And here in container freight shipping, that's exactly what I just read out as well. Here too, we will probably see higher dividends in the end if it stays this high. Yes, that's basically the important insight for now. Let's take a quick look at the macro situation and see what we currently have. We have an inflation rate of 2.43%. Currently, things are just in a wait-and-see mode. The key interest rate at 3.64% is currently neutral. Otherwise, the money supply is at 4.29%. The unemployment rate is at 4.4%. Currently, we have a volatility index of 27%. A volatility above 25% is considered high. This means that prices can quickly rush up or down. Otherwise, 4. The greed index is currently at 20. Well, due to the current market situation, many investors are simply a bit in the 4 range. Good entry points can also arise for us, so just keep your eyes open here as well. Yes, otherwise that was basically everything described for now. So, what exactly can we take away from the events of this past week? I mean, what can we truly take away? This week has clearly shown us one thing. Why is there absolutely no room for speculation in a well-balanced portfolio? They are hedges. Oil over 100, gold over 5,000. The supercycle in commodities is real, but it's not a guarantee. It's not a free pass. The volatility is simply enormous, and you have to be aware of that, but also, I also communicate this very transparently here. Looking ahead to next week, Trump's trip to China at the end of March, new developments in Iran, and whether the strategic oil reserves can stabilize the price. If this analysis helped you, feel free to subscribe, leave a comment on this video, and also give it a like if you enjoyed it. If you feel like you'd like to share this video and inform others, what is happening now is what's currently going on in the market and what impact it has. I would really appreciate it if you did that. Otherwise, as you probably noticed, my newsletter has now also been launched. You can sign up for it at any time. Of course, it's free, and you'll get everything I ever have in the MP Finance Made dashboard and basically all the news. The most important updates for my stocks are practically sent directly to you. It's about 3 to 4 pages, which I personally find very exciting as an addition. In the end, it's great for when you don't always have time to watch the video, or if you want to dive a little deeper into a particular topic again. Otherwise, of course, the video is not investment advice, but simply my personal strategy and assessment. Of course, given how things are currently going geopolitically, I don't think I need to explain that it's not enjoyable to report on this. These are simply the hard facts. That means I stay out of politics and simply report on what impact this has on your or our portfolio and also on the shipping stocks. Otherwise, I wish you all successful investing, take care of yourselves, and I'll see you in the next video.